Okay, let's start. So the salvage value happens to be at the end of 5 years. So we're looking for the present value factor of I equals 10, N equals 5, and that is 0.6209. So we're going to multiply the $20,000 . This is 12,418. So let me add all of these. So I got 12,418 twice, plus 416,988 minus 340. I get 101,924, and that is positive. And positive means that we will move forward with the investment using NPV. So we know that at least it's generating at least 10% of the investment. Now, let's do the IRR. IRR requires us to find the rate of return that inflow equals outflow. So the outflow is 340,000. Okay. I'm going to put that minus, plus the inflow is going to be 110,000 x. Now, let's assume that this salvage value and working capital, because again, what we're going to do is we're going to probably do trial and error, right? So 40,000 times x, x being the factor, equals 0. So let's do trial and error. So let's say, so I just want to do this equation for a minute, right? So let's say it's 340 equals 110,000 times table 2 factor, n equals 5, plus 40,000 table 1 factor, n equals 5. So we're going to do trial and error. So trial and error. So let's go with, let's assume that the first trial is, let's go with I equals 20%. So at 20% rate, let's see. They're going to take 340 minus 110 times table 2 at 20%, I equals 5 is 2.9906 minus 40,000 times table 1, n equals 5, n equals 5, I equals 20. We're going to use 0.4019. So let's calculate that. So it's going to be 340 minus 328,966 minus 16,076. So that would be minus 5042. Okay? So let's try 25%. That's what would be my next guess. And I'll show you why I picked a higher rate. Let's say at 25%. What would be my present value amount. So it would be 340 minus 110 times, now what's the present value factor of annuity at 25%? It would be 2.6893. Now I'm getting these, n equals 5, I equals 25. I'm getting this from your present value factor table. Minus 40,000 times n equals 5, I equals 25%, table 1. That would be 0.3277. You'll see in a minute why I've done this. Assuming I did not make any calculation error. So this is a positive 31,069. So what we want is we want to guess what rate is going to make the NPV equal to 0. So we've got one that is positive and one that's negative. So we know it's between 20 to 25. And the reason why I picked 25 is because I wanted the interest rate. I first picked 20, and you'll see that 20 gave me a negative. That means that the present value factor is too high. So for me to lessen the present value factor, I need to go with a higher interest rate. So this is called interpolation. So let me show you how to do this. So I equals 20%, I have an NPV of minus 5042. At I equals 25%, I have an NPV of plus 31,069. So I know it's between 20 and 25. So I know that it's going to be the interest rate called IRR equals 20% plus. Now, what is the difference between these two? It's going to be 5% times. I'm going to prorate it. So I know that it's 5042 minus 0, because I want this to be 0, right? I want this to be 0. I want to know what the I is. Okay? So I want this one. I want the 0 amount. So I know it's between these two. It's 5042 divided by the sum of these two. I need to come up with a whole number, right? I have to look at the absolute number. 5042 plus 31,069. I want to make sure that this number is right, first of all. So 295,823 plus 13,108 minus 340. Yeah, this is right. Okay, so now it's 20% plus 5% times 5042 divided by 36,111. So it's going to be 20.698%. So that is the IRR rate. Now, you could use an Excel, clearly, but we're going to use the present value factor table, and I wanted to highlight the interpolation calculation. Okay? Next, let's do payback. So remember, payback is all about how fast, right, we're able to get our investments back. So our total investments is $320, and our actual cash flow is 110. And that gives me 2.73 years. Now, we don't include the working capital, the residual, because the working capital we know we get back. The payback does not incorporate time value in money. That's one in negative. It does not incorporate profitability also of the project. It just measures how quickly we're able to recoup our original investment. Our original investment is $320, and we're going to recoup, and it's going to it's $110,000 of cash flow. Now for D, it says accounting rate of return. So A, accounting, ARR. So what is that? Remember, it's going to be accounting income, which is cash flow less depreciation. In that case, that was given to us at 50, divided by the investment. And the investment, we know, is $320, but we're going to get $20,000 back of that. So it's really $300. Again, we're going to ignore the working capital because that working capital comes in and out again. And given the fact that we don't care about time value in money, we just want to know what the rate of return is, and this gives us 16.67%. Now, the next question in E says, should KTI invest in the project? Well, the answer is, for NPV, we calculate NPV to be positive 101,924. IRR, we said it was the IRR is 20, is greater than 20%, which is greater than the 10% required rate of return. So that's good. That's positive. So it's good. And the payback is 2.73 years, which is greater than 2.5 years. So this is a no for sure, but it's close enough, isn't it, to the minimum 2.5 years. So it's not a huge no, but it's close enough to the 2.5. So to me, all of this signals that perhaps, so overall, yes, we should invest in the project. Because this is large enough. To me, this is significant enough. And this is really not that big of a deal. It's not a huge difference. Okay? Thank you. Okay, I'm ready. This mock exercise, we're going to take a look at capital budgeting decision and cost analysis. And we're going to use a case called KTI Incorporated. And we're going to take a look at some of the techniques on capital budgeting, such as NPV, IRR, payback, and accounting rate of return. Those are the four methodologies used to evaluate capital budgeting decision. Let's take a look at the question first. So this question KTI is considering a project where it would have that will have a 5-year life, so that's the period, and requires $300,000 in investment of equipment. The project will release working capital at $20,000 at the beginning of the project. At the end of 5 years, the project would terminate. The equipment would have residual value of 20, and the working capital will increase by 20,000. So basically what's happening is we will need initial working capital requirements to start the project. So there's a $20,000 need of cash, but at the end of the 5 years, that $20,000 will be paid back to the business. In other words, the business can utilize that cash and can generate income in the form of interest after the 5-year project. The project would include, would have a net income of the following items. Okay? So it's got sales, variable costs, contribution margin, fixed cost, and net income of $50,000. All the above items, except for depreciation, represents cash flow. The depreciation is included in the fixed expenses. So we need to know how much depreciation is in this number. Okay, how do we determine that? Well, we're going to take $320,000 as the cost, less the residual value is 20 divided by 5 years. And that gives me 60,000. So that 60,000 is the amortization, so depreciation. That's sitting in this other fixed expense. Okay? So we're going to need to know that as well. Now it says KTI's required rate of return is 10%. And payback is 2.5 years. Okay, so before we get started, they're asking us to calculate NPV for part 1. Part 2 is IRR, payback, and accounting rate of return. Let's take a look at the technical material. So first of all, in capital budgeting decision, we often use cash flow to evaluate whether the capital decision makes sense for the company. And discounted cash flow, it basically measures inflow and outflow of the project as it occurs at a single point in time. We're going to not focus on net income, and the two most common methods of using discounted cash flow is the net present value and the IRR approach. And the decision criteria for net present value is we're going to discount all expected inflows and outflows using a minimum required rate of return. So that's what we're going to use. And if the NPV is greater than 0, we accept the project. Okay? So we're looking for a dollar amount. If that NPV calculation results in a positive dollar amount or 0, actually, it means that this investment is generating a minimum required rate of return of at least whatever the desired rate of return is for investment purposes. Under the IRR approach, which is the second method using discounted cash flow, the decision is a little different. What the decision says is, what is the actual rate of return for this project in which inflow equals outflow? And that rate of return is compared to the minimum desired rate of return. So what we're doing is we're actually comparing whether the rate that we determine by doing that calculation, is that greater than? If it is, that means that this investment is generating a minimum required rate of, or at least the required rate of return. And if it's less, that means that it's not generating the required rate of return. Okay, so those are the first two methods. Now, there is a ranking process. If you are faced with perhaps multiple different investments, decisions, we need to be able to rank them. And to rank them, we're going to use what we call a profitability index. And the profitability index is allowing us to rank the investments to see which one is better for the company. And we're going to take a look at it by dividing the present value of the benefits divided by present valuing of the cost. And again, this allows us to always do the ranking based on it allows us to rank the projects based on different sizes, because you could see that if you have a project A that's a $100,000 investment versus project B that's $1 million versus project C that's $10 million, you'll see that the NPV gives us a value, a number, and it's hard to compare which investment is better because obviously the size of the investment is going to matter. That will dictate the size of that positive NPV or not. But when you do the profitability index, it allows us to then basically compare the different NPV based on various sizes. Now, the other two methods is the payback that's talked about in this question. And the payback basically is, I normally would use this as a screening tool as opposed to a preference tool. And it allows us to completely say how quickly are we able to get the investment paid off. So we're looking at cash flow. We want to know the length of time it takes for the cash generated from the project to at least cover the cost of the initial investment. And here it's the investment required divided by the annual increase in cash flow, and this gives us a number period. And normally the smaller this number is, the quicker it is, and the quicker it is, the faster it is that we recover, the less amount of exposure we have for the company. Now, this formula ignores the profitability of the project. All it does is allows us to focus on the length of time it takes us to recover the original investment. The final, the final method of evaluation is called the accounting rate of return. And this one actually is not about cash flow. It doesn't focus on cash flow, but it focuses on accounting income. So what do? We take the incremental revenue minus incremental expenses minus depreciation. So essentially, we're looking at the incremental profit of this investment, and that would include the depreciation. And we're going to divide it by the initial investment. And the initial investment should always be reduced by any salvage value from the sale of the old equipment. And you can also use average book value of fixed assets as well as the denominator. Okay, so let's see if we could solve this problem and apply what we just learned through this problem. So the first part is asking us to calculate the net present value. So the NPV. So first we're looking for the investment. So what I like to do is I like to do a chart that says investment. This is the years, the amount, PV table, right? PV factor, and present value dollars. Okay, I like to use a chart because it's much easier. It's visually also appealing to see. Now, investment is time 0, which is today, and the amount is I'm going to put a minus 320, and the present value factor. In other words, if you invest today, the value of that dollar is equal to the face value of that dollar. That's $320,000. And by the way, negative means outflow, positive means inflow. Now, it says that we need working capital, so working capital requirements. Again, at time 0, we need 20,000. And the present value factor is 1.000. Now, what's the annual cash flow? The annual cash flow and so we've got the net income, which is 50,000. We're going to add back depreciation, which we just calculated as 60,000. So it's going to be 110,000. And we know this is from 1 to 5 years. And the present value factor of that an annuity table is 3.7908. And this is, by the way, the present value factor is 10%, right? This is the rate of 10%. So that's the present value factor for 5 periods at 10%. And we're going to assume these cash flow happens at the end of the period. And this is 416,988. Now, there's also the terminal value, right? The salvage value. The salvage value is at the end of 5 years. The salvage value is 20,000. Okay, and then the 20,000, we're going to present value that using the time value in money. And I don't have a factor for you. Okay, so whatever this factor is, and we also have a working capital release. At the end of 5 years of 20. So these are positive cash flow because we're going to get that money back. So we need the requirements. Now we've got this capital release.